And so this morning I was looking for, so some of you might have read the abstract that was sent around for class today. My name is Frederi. Viens. I'm a professor here in the stat department. And
you can say what you want.
I'll probably just stand, yeah. And so in the abstract, you probably saw that we're going to be talking about the U.S. agricultural system and what to do to make it more sustainable. And one of the things that I was looking for this morning was my John Deere cap, so that I could pretend to be a farmer for the purpose of this class, and I couldn't find it. So this one it says Walla Walla, Washington. So it's also kind of a farmer's cap, but it's not necessarily related to farm equipment. It's just about the city in the state of Washington. So what we advertised for class today, and thank you all very much for coming. So I think, could you please raise your hand and let me know which ones of you are actually enrolled in Professor Dolan's course today? All right, so there's about...
And then 2 online.
And there's 2 more online. Thank you very much. Yeah. So it's a pleasure for me to be here today. We're going to talk about risk, which is, I think, a topic that you've talked about a lot in some of your classes, including Professor Dolan's. So I'm hesitating as to whether I should go through the material that I actually spelled out in the abstract, or if we should just jump into the topics that I wanted to speak about, specifically about what we're doing on these couple of different research projects. How many people read the abstract? Okay, thank you, Professor. Okay, so if you didn't read the abstract real closely, let me just maybe go over, and so we are recording, yeah, right, yes. Let me just go over quickly what the issues are. The main issue that I'm concerned about and that we should all be concerned about, and before we even do that, very first thing, let me make sure that my phone is on silent. Yeah, I think it is, yeah. Second thing, I'd like everybody to repeat after me. All right, so repeat after me. No farms, no food.
No farms, no food.
Thank you very much. Yeah, thank you very much. No farms, no food. Okay. All right.
Well, we have a hydroponic growing that's going on.
Not quite enough. Not quite enough to feed the world. Yeah. All right, so repeat after me. No farms, no food.
No farms, no food.
All right, how about this? How about that? You learn in logic? No soils, no farms, no food. Please repeat after me. No soils, no farms, no food. So it's true that we do, and in fact, I'm an honorary Canadian. I don't know if you knew that. My wife is from Western Canada, and in the United States, especially in the Midwest, we get a lot of our produce actually from Ontario, strangely, Even in the western states, some of the produce actually comes from the Okanagan Valley in British Columbia, where there are some fruits which are grown on trees and other things which are grown in hothouses. And in Ontario, it's a very common thing, even though people think of Ontario as being a very cold part of the world. They do grow a lot of the produce that we consume in the United States. Unfortunately, we can't just all live on fruits and vegetables, most of us anyway, right? And in the United States, and the rest of the world is actually following us. This is the issue. The rest of the world is actually following the lead of the United States in what we produce and what people want to eat. A lot of folks want to eat richer foods than just fruits and vegetables and grains and nuts, and so we have to produce food for the animals that we produce so that the people can actually then eat meat. And so this is what's going on. If we were living in a perfect world where everybody were able to be a vegetarian or even a vegan, then we would not need to worry about the difficulties that the U.S. farming system is about to encounter in the next 10, 15, 20 years. The difficulty is that when we're producing food like beef or pork or lamb or chicken or even eggs and milk and cheese, all these things require animals to be fed. And how do we feed animals in the United States? And again, the rest of the world is kind of following in this lead. In the United States, we feed animals corn and soy. It would be better if we could feed them pasture, but pasture is a more extensive type of crop to be grown so that the animals can feed on pasture. In places, I'm trying to get a little technical on the agricultural side so that everybody understands what the issues are. And has anybody ever heard of the state of Wisconsin? Yeah? So you know about Wisconsin, right? There's other states where, Pennsylvania is another state where, so what's going on in Wisconsin is there's a lot of dairy farms. Pennsylvania is another state like that. So We have a lot of dairy farms in the United States. In fact, the US is the second highest producer of milk products in the world after France per capita. So it's a very important thing here in the US. We drink a lot of milk, we eat a lot of cheese. So Wisconsin's important, Pennsylvania is important for the entire food system in the US because we eat so much milk and cheese. Milk and cheese is produced from cows who cannot feed only on grain, so they feed on things like alfalfa and other types of pasture. But it's actually not sustainable. We don't have enough land in the US to be able to feed all the dairy cows on alfalfa and grass pasture and do the same for all the meat cows. So that's why it's literally impossible for the US system to produce enough beef to feed all the cows that we want to eat as a society. Now, so there are solutions. So you might say, how are we going to handle this type of risk? Like if we are feeding all our cows corn and soy, which is what we're doing, and that's not healthy for the cow. Did you all know that it's actually not healthy for the cows to be eating corn and soy? This is something that we should call an externality, and how do we price it? Have you guys talked about externalities in maybe your econ class or your risk class? So sometimes we do things which are bad for the environment for various different reasons, bad for the climate. That's going to hit us later, maybe 20, 30 years, we're going to be paying the price for all the problems that we're creating now because of climate negative impacts, which we'll be feeling later. We should probably be pricing those externalities. Have you guys talked about carbon pricing a little bit? The price that we have for carbon today in the carbon markets is far too low compared to the actual estimated price of those externalities 20, 30, 40 years down the road. But it gets even worse than that when you start thinking carefully about the entire farming system, because there's externalities on the animals that we're growing. How do we price the negative impact on the welfare of the animals that we're growing for our own consumption? It's not okay for these animals to be eating only corn and soy. It makes them sick. We are sending sick animals to slaughter, and that's how we enjoy our hamburgers when we go to McDonald's. And even if we don't eat beef, there are other externalities like, so how do we price the negative impact on the animal welfare? That's a very difficult question. Actually, financially, it's not even clear what to do. So we have groups of people who are animal welfare advocates, but how much power do they have? Do they have any economic power? These are questions that I ask myself all the time. I don't have the answers. I don't know how animal welfare advocates have economic power in the global agroecological system in the US. The same thing happens. So I'm just painting a very negative picture so that you can see why this is all extremely important. There's also the case of poultry. In the United States, we eat a lot of chicken. Anybody here eat chicken? Who enjoys eating chicken? Anybody here like to eat chicken? Everybody likes to eat chicken. I mean, people who aren't vegetarians will enjoy chicken. The case of chickens is even worse than the case of cows because the chickens have been genetically modified to reach maturity when they're only 45 days old. And normally you would wait 90 days before you slaughter a chicken. And so I don't want to describe what it means to be able to produce a chicken who grows twice as fast as what a normal chicken would grow, but that's another problem. How do we price that externality? So these moral externalities that we can't even necessarily price. So we could all just throw up our hands and say, I can't do anything. But then we can go back to the original question of what are the other types of externalities that we have that we can actually price when we're producing corn and soy for the consumption of cows, which we can then send to slaughter and then sell to supermarkets, which then sell them back to us. Those things are a little bit clearer for us to do. So there's moral issues at stake, but there's also economic ones. What is the long-term impact of producing cows who are, number one, are sick, so that's a moral question, but number two, are monopolizing a very large proportion of all the farms in the United States. Most of the corn and soy which is grown in the US is used for cattle feed. And it's a minority of the soy which is used for direct human consumption, and I think corn is even a smaller proportion. So we have to realize that in the United States, and so I'd like to know also, the folks here in the room, has anybody here recently driven through the Midwestern US states? Yep, one person. So Professor Ansor, maybe you'll confirm that when you're driving through the Midwestern US states, you can go north, south, east, west in all directions, and it really is a very, very long way. You can drive for a couple of days, 3-4 days. If you drive all the way from the eastern side of Ohio to the western edge of the western prairies, you're going to encounter a majority of land which is occupied by corn and soy fields, am I right? So it really, it is a
And you can ask
huge,
who's flown over it, because you can.
and you can even, yeah, if
see
you're paying attention when you're sitting, if you ask for an aisle seat on the plane, you're not gonna realize, but if you ask for a window seat,
You really should.
you will see what we're talking about. So, I mean, people have heard of the country of Ukraine. Ukraine, am I right? Yeah. So, Ukraine is a major producer of grain. There's corn and there's wheat. Wheat is not a major crop in the U.S. compared to Canada and Ukraine, but Ukraine is also playing a major role in feeding the world. We know how large Ukraine is as a country, but the United States is actually much larger. The area that's grown in corn and soy in the U.S., people are all very concerned about the risk that the entire world is taking by the fact that Ukraine is maybe not able to produce as much corn and wheat as it should, and that affects the prices. The price of corn has gone up substantially because of the war in Ukraine right now. But imagine what would happen if there was such a shock, maybe not due to war, but due to some other problem in the U.S. We're talking, the United States, Midwestern states are several times larger than Ukraine, and it's the same sort of economy. It's all based on corn and soy, wheat to a lesser extent. So we're talking about possibility of major impacts on financial markets. If the prices of commodities, if the price of one commodity goes up, it can actually create ripples throughout all the commodities markets. Even things like oil can be affected because now we're talking about a situation where we might have a shortage of corn, and then you need to transport it, and so of course, this is something which now I don't know about this stuff. It's like how is the world transportation system working in terms of getting corn from fields to markets, because it's such a global commodity. So I don't want to talk too much about that, but everything's connected, and so we really need to try to understand. So the upshot of all of this is we need to try to understand how to make the commodity systems, and particularly one that interests me today is the food system in the U.S., more stable, because any slight little shock into the system, or even a relatively large one like what's happening in Ukraine, has rippled all over all the markets, and so we really cannot afford to have a large shock in the U.S. And so everybody's definition of what a shock is could differ, but if we're talking about a deterioration of the U.S. Farming system over a span of a few years, as might happen under certain climate scenarios, that over a scale of several decades, that could actually also be considered a shock. It could send the entire world economy into a longer-term recession. So we're talking about very, very serious problems here. And so when you speak with folks about what this all means to U.S. society and to world society, again, the entire world is following the lead of the U.S. If we think we're eating too much beef now, it's only going to get worse going into the future. It's not going to get better right away in the U.S. and in other countries who are following the lead of what the U.S. wants. And I know this because I've traveled to several other countries in this world. I just got back from Ethiopia. Anybody ever heard of Ethiopia? Ethiopia, yeah, raise your hand, yeah. It's a country in Africa. It's the second largest country in Africa by population. Population 120 million, which is more than one third the size of the U.S. by population. So it's a very large, it's an important country because it has so many people. Not exactly the poorest country in the world. I was in Addis Ababa. There's an expat neighborhood there where the rents are twice what they are here in the middle of Houston. So we're talking about an economy which has some positive aspects. And people in Ethiopia are not super poor. You don't want to imagine them like you did in you weren't alive in the 1980s, but some of you were maybe. But in the 1980s, there was famine in Ethiopia. Maybe you heard about the famine in Ethiopia back then. It's not like that anymore. The U.S., the world agricultural systems have stabilized to a great extent to avoid famine. What we've not addressed necessarily is the future growth of demand. So sometimes you'll hear folks say, well, the world population is not growing as fast as we thought it was, so we're not going to really have a problem feeding the rest of the world because people used to project that the world population would reach 12 billion people in maybe a couple of decades. We know that's not going to be the case anymore because birth rates have gone down substantially in almost every country, including Ethiopia. What it is that everybody demands richer foods, just like we have in the U.S. And the reason for that is that we won't get into that. Everybody's demanding richer foods. It has nothing to do with out-of-control population growth. It simply has to do with demand and managing a system on a finite planet where that supply can actually satisfy the demand. That makes sense to everybody? So we're talking about a system which may be unsustainable simply because demand is going to outstrip the possibility of supply to supply the products that we have. And there's nothing in this whole equation of how the supply keeps up with demand at the expense of the environment where we're growing the things that people are demanding. And that entire question, nothing is more important than growing corn in the Midwestern US states. It's the biggest, if we can understand how to make growing corn in the Midwestern US states more sustainable, there's nothing more important in the entire world economy of the food system than that one particular question. So, so with that as an introduction.
So
yes.
Are the farms in the Midwest mostly corporate farms now, or are they still individual owned? Or?
That's an excellent question, Professor. So I don't have the numbers off the top of my head, but they are quite extreme. So the case of dairy farms is really striking. I think I know those numbers. Dairy cattle, very important in America, you know, almost as much as France, and more important than any place else in the world other than France. Very important. In 1980, I think the number was that there were 4,000 dairy cows in the United States. 4,000. And dairy production has gone up substantially. Americans are eating more milk and cheese than they used to eat. Does somebody want to guess what the number of dairy farms is today compared to 30 or 40 years ago?
Dairy farms or dairy cattle?
Dairy farms. Yeah, dairy cattle has gone up. What about the number of individual dairy farm operations?
Probably 100.
That's a little extreme. But yeah, it's around 1,000. So we've lost 3/4 of our dairy farmers in America because, and so this is maybe getting beyond what I wanted to talk about today, but it's also important, so I'm glad you brought it up. The way that you can be a dairy farmer in America has become so difficult. Consumers and distributors are demanding such low prices that only the largest dairy farmers can actually survive. Every small dairy farmer, almost every small dairy farmer has been put out of business. It's impossible to survive as an individual, as a family, if you're a dairy farmer on a small farming operation, unless you have some other jobs. And so there are small dairy farms, but they just don't pay the bills at all. And in a lot of cases, people use their income from, like you could be a school teacher, which gives you a lot of free time, and then on your free time you can be a dairy farmer, and that's how your dairy farm survives. So 1,200 or 1,000 dairy farms is what we're looking at today compared to three or four times as many 20, 30, 40 years ago. So that's the case of dairy farms. In the case of corn and soy farms, I think the numbers are not quite as bad, but they're scary too. They're scary too. So the corporatization of farming in the United States. I was actually just reading an article this morning because it's tax season right now, where it was just talking about how farmers can take deductions for certain types of things when they're doing their taxes. But the key message was there's so many corporate farmers in America, and they're making a ton of money, and they're just always struggling to find deductions so they don't have to pay too many taxes. Yes, sir?
Maybe I missed this part, but
yeah.
You're saying it's scary. Why exactly is it scary that the farms are becoming more corporatized?
Oh, thank you. That's such an, I'm just assuming that you would agree that reducing the number of farmers is not a great thing from the standpoint of stability. The larger your farm gets, the more uniform the type of farm becomes. The more uniform the type of farm becomes, the more vulnerable that type of farming operation becomes to specific types of risks. If every major farmer, or if let's say 95% of the corn and soy that's grown in the United States is grown on farms which operate according to one single model, that, because it's a very good model, because of the incentives that the government provides for these types of farming, it's a very good model right now. That type of farm will be vulnerable to the same problems across the entire sector. And so, like war in Ukraine, luckily it hasn't been too bad so far for American farmers. It's driven the price up, which is actually good for them. But there's other shocks that we can't even predict. And so that's the thing. You guys are understanding, questions of finance. In finance, when we study things like markets and market prices and volatility, we don't necessarily try to predict where the shocks are coming from. Am I right? You guys have looked at prices. Has anybody tried to estimate volatility of prices? Is that something you guys do in this risk classes? A little bit? Yeah. We're not economists, really. I'm certainly not an economist, all right? Anybody here consider themselves an economist in this room?
Yeah.
Yeah, a little bit. All right, you guys are better?
Fisher's getting his Ph.D. in economics.
All right, okay, good. So there's only a couple of economists in this room. The rest of us are not economists.
Yeah.
We're not pretending to understand where the shocks will be coming from. We just want to, in fact, I put myself squarely in this camp. I don't understand what's going on in the future of economics. I just look at the past. We have a lot of data for the last 100 years of financial markets. There's a lot. And we can understand what volatility has done historically over the past 5, 10, 15, 20, 30 years. Just look at the S&P 500, gives us an idea. We could look at commodities markets, the same thing. And that's how we say, there's going to be financial shocks. We don't know where they're coming from, but we have to be ready for them. And so I'm not even saying that those corporate farms, that we know where the problems will be coming from, but we know that there's going to be market shocks, which might be driving the prices down. And then how are these farms going to adapt to those shocks? Is the farming system going to go through a difficult time, which might even lead to a collapse of distribution of the commodity? Will the farmers actually go bankrupt? What happens when a large farm goes bankrupt? These are all risks that whose sources we don't necessarily understand, but we have to be ready for them. And so we have to provide tools to farmers in order to manage these risks.
Is there a systemic risk measure for farms, for like the big system of farms? Like we have systemic risk measures for banks and things, do we have?
Yeah, so there's for international banking, there's things which are in place like the Basel III.
Okay.
But for farmers, actually, so I think the answer is no. I've not even thought about it, but what I do know is that in the United States, which is what I'm talking about here, the financial system is organized in a very particular way. If you look at all the incentives that people in Washington, people in Congress in Washington, when they're writing laws which design ways to help certain sectors of the economy, you look at all the different types of incentives that the US government is able to come together on in Congress to produce laws which will help certain types of sectors of the economy. So what are the sectors which the US tries to support strongly? Well, there's the oil sector, here we're in Houston, we know that, right? So there's the oil sector, there's maybe a couple other smaller sectors like aeronautics, in the United States we have Boeing, and that's a very important sector for us, and it makes us look good. So that's also highly subsidized by the government. But nothing is more subsidized in the United States than the farming sector, and that comes from the farm bills, which are passed every so often by Congress. And the most expensive, the most important, the most powerful tools which exist in the farm bills which are passed by Congress, all this money which is allocated to give to farmers, are the crop insurance systems. So what does crop insurance look like? I'm thinking probably today, because we're recorded, and I was thinking of writing stuff on the board, but maybe I'll just talk because there's so much to talk about, if that's okay with everybody.
Right. Don't let the recording limit you. So.
Yeah, so I may just talk, right? So without having to write anything, and then I'll describe by waving my hands what would take longer to write on the board if it's okay with everybody. Yeah. So how does crop insurance work? There's actually a couple different things that crop insurance can do. The most popular form of crop insurance is for a farmer, and they work with their farm lender. That's how they get their crop insurance, even though it comes from the funds come from the feds. The farm lender, it's like a bank, is lending money to the farm, gets together with the farmer, with the farm operation, and they figure out what their historical revenue has been over the past 5 and 10 years. So I'm in discussions with this group with whom we're working. It's a nonprofit group called LandCorp. I don't know if I put that in the abstract, but I'm working with a group called LandCorp where we're trying to deal with this whole idea. I'll talk about it in a minute. With this group, LandCorp, we're talking with a major farm lender in the upper Midwest. And so we actually have a foot inside the door of an actual farm lender, and the folks who are talking to the farmers, they used to be farmers themselves. So these are finance people who used to be farmers. So we're talking about folks who really understand how farming operations work. And so they figure out what the farm is worth, what the historical yield has been on this farm. That allows the lenders to actually write loans for these farmers so they can expand their operations or so they can operate in more difficult times and whatnot. And one of the important things that they also do as purveyors of crop insurance that actually is paid by the US federal government, they figure out using this historical revenue, that's what they insure. So if you think about a financial option where you say, okay, let's think for instance let's think about a call option. Everybody know call options? You know how call options are designed? You have a it could be a stock price or some other type of time series that's measured in dollars, and then you want to predict whether it's beneficial for you to be able to maybe get into that revenue stream at a certain time in the future at a specific price. If you want to try to buy it, that would be your call, and then you want to set a cap on how much you're willing to pay, and then it might be higher. You don't want to pay that much, so you buy a little piece of insurance to ensure that you only have to pay up to that cap, which is your strike price. Right? So this is a call. Well, it's a very similar thing in the case of crop insurance, which is based on the farm revenue, except it's going to be on the low side. The farmers and their lenders figure out what the risk is that the farm revenue will fall below the number that people like to use is 80%. You look at the long-term farm revenue on average over 5 or 10 years, depending on what the lender and the farmer wants to do. You look what the chance is that the revenue next year will fall below 80% of that long-term average revenue. Very simple, right? You just look at the long-term average revenue, the 80% level of that. So you have to have some data that you can use in order to calculate the chance that that revenue next year on this particular farm will fall below that 80% level. Using that, you can just use tools which are similar to what we would use in ordinary risk management and finance to compute the price, to compute the value of that contract, which says, if my revenue falls below, if my revenue from selling corn on the open market falls below 80% of what I've been expecting in the last 10 years, the federal government, through my farm lender, will give me the difference. That's exactly like a call, right? Yeah. So now, interestingly, so how do we know? So I think you guys know this. When we're doing pricing of calls and puts, what's the underlying? I'm going to ask a question. What's the underlying philosophy behind it? How do we even find a price? What's the concept that we use in order to determine the price of a call? Anybody want to tell me, like, maybe one word or a couple of words? What's the idea? What's the principle? There's a principle we use. What is it called?
Volatility.
Volatility that's part of the model. Yes, it's important, and that's how, by determining volatility, we can actually do the computation. What's underneath the computation? What's the principle?
Are you looking for Black-Scholes?
That's also the model, I would say. But there's a principle, whatever the model is. What's the principle that allows us to say, that is the right price, and I don't care what anybody says? What's that principle?
Arbitrage.
No arbitrage pricing? Yes. There's an even more specific thing that people do in order to say this has got to be the price. In financial markets, I'm looking for no hedging. Hedging? Yeah. Hedging, because if there's a way to replicate the value of your option into the future at a certain present value price today, that's got to be the price. There's no argument because you have a way to replicate. So if there's a way to replicate, then that's got to be the present value of that replication strategy. It has to be the price today. Everybody see, right? There's no question about it. And Mr. Tech, he used the term, what was the term he used?
Arbitrage.
Yeah, so the arbitrage-free idea is that there really is a way to actually replicate that price. And if there's a way, there can't be two ways because that would create an arbitrage, which is a free lunch. And if you believe that your model does not contain any free lunches, then the price of the option through the argument of hedging has to be unique. Everybody see how that works? Yeah. So arbitrage, if you have an arbitrage-free model and you can actually replicate an option, that is an arbitrage-free and complete market. Replication strategy exists. It's got to be unique because there's no arbitrage. That's your price. It doesn't work that way with insurance. Anybody here has studied insurance? Am I the only person who knows about insurance pricing here in the room?
Probably as in-depth as you know.
I don't know about in-depth, but it's actually really simple, believe me.
Yeah.
It's so simple. I'm going to explain it to you without writing anything on the board. So the problem with hedging in regular financial markets is that most markets are arbitrage-free. The markets which are not arbitrage-free, people end up going to jail when they trade in those markets. Yeah. I mean, there's regulation that needs to catch up, so some people are not going to jail yet. Yeah, right? But they ought to be sued.
You can trade, there's an arbitrage opportunity between the US and Europe.
It exists. I mean, the laws
on
are
a small scale.
Yeah, that's right. I mean, for those of you who know ultra-high frequency trading in New York, that's real arbitrage.
Yeah.
And it has to do with how close you can get your office to be next to the computer where the prices are actually determined because you can get a latency arbitrage there. It's ridiculous, and that's how people are making money in those firms. It's absurd, but they claim it's creating liquidity. I don't think so. I think they should go to jail, but that's just me. So, because I'm a farmer. Oh, sorry, that's not John Deere. That's not a farmer. So arbitrage in most markets doesn't really exist, but there's another problem. Most of these markets are not complete. You cannot actually find a hedging strategy. The best you can do is find an approximate hedging strategy, and if the strategy is approximate, then you're going to get an approximate price, then there'll be people arguing then you have to use the open option market so that the traders can actually decide what the right price is. So it's a little fudgy, right? In some sectors, the lack of replicability of the contracts that you're trying to sell is so severe that we can't really say we're going to find an approximate hedging strategy and then we'll let the traders decide what the real price is. It doesn't even work. And so that's very common in the insurance sector. In the insurance sector, the major companies which are selling contracts to small people like farmers or like individuals who are trying to insure their cars, they get around this problem by working with other companies who are called reinsurers. Have you guys ever heard of reinsurers? So the severe lack of completeness of markets in the sphere of selling insurance contracts is such that they need to create a new sector of the economy, reinsurers, whose pockets are extremely deep, and then the reinsurers can decide on their own, on a contract per contract basis, how much extra they will charge beyond what would be considered a fair price to the insurance company for the privilege of them backing the insurance company when the risk goes above a certain level. That make sense? Yeah. So reinsurers step in when a regular insurance company takes the aggregate of all their contracts together. It's actually interesting the way it works. The insurance company and the reinsurance company, they talk to each other in a boardroom or wherever it is. I've never been in those rooms, but I know that they're there. They talk to each other in a closed room. It's not on the open market. Every contract is unique. It's not at all like anything that's traded on any market. And the reinsurers are able to say, yes, we will agree to this contract, and we think that we need to charge you this much of a fee so that we can run our own operations and pay our own employees. So it's really completely different. You know, in financial markets, we say, there's a bid-ask spread, and that's how market makers can actually make a living. And but then things are still in a very liquid market, which is like in the markets there in most of the markets in the U.S. Even with that bid-ask spread, the transaction costs are small enough that really we can consider that things are infinitely liquid in most cases, and they really are mostly complete, and they are arbitrage-free. So it's a very efficient system. Insurance is not at all like that. You have reinsurers who are dealing privately with every major insurance company to create contracts, and then the reinsurers decide to slap a price tag as a fee on top of the regular fair price that they can both agree on, and then the reinsurer will say okay, or they'll say no, and that's it. And then they go to the next reinsurer if they think that the fee is too high. So the fee is much, much larger than what you would expect to see in a regular financial market. And I have a couple of papers on this topic which are very mathematically uninteresting, but there's ways that you can actually try to create there's a Nash equilibrium that you can find when there's two different insurers which are competing for the business of a reinsurance company, and there's actually a Nash equilibrium that you can find where the reinsurer is the one who decides everything and the insurers think that they're getting a good deal. So that's interesting. Yeah. So that's how hard it is to do pricing in the insurance sphere. So just forget about the fact that there are fees, and that's, for instance, what the reinsurers are charging so that the insurance company can actually stay in the black. The pricing principle for insurance is very different from what we've described just a minute ago, the pricing principle for financial insurance against financial risks, like insurance against the price of the stock going above a certain level. So that's a call price. That's a type of insurance. A call is a type of insurance. It's not at all the same type of pricing principle that you would use in a highly non-complete market like we have in most insurance sectors. And the pricing principle in insurance is just so simple-minded, you're probably going to laugh if you've never heard it. They come up with a model which tells us, in the case of farming, for example, what's the chance that my revenue will fall below 80% of my average long-term revenue. So we'll figure out that chance, so it gives me a number. Right? Let's say it's maybe 10% chance next year. And then there's also the gap between the 80% and what actually happens. So there's a distribution there. So they figure out, below 80%, that's what the crop insurance needs to pay. So the distribution of how big that number is going to be, that's just a number, right? It's just a single random variable. Everybody in here know what a random variable is? Just making sure, yeah? Okay. So you have yourself a random variable which represents the difference between the 80% level and what you actually made, and the insurance will pay you that difference. You find the distribution, one single random variable, not a Black-Scholes model, all right? Not a stochastic process, one single distribution for one single random variable year to year. The only other piece of information is how likely is it that I will have to pay out anything at all? And that's the chance that the price will go below that 80% level. That's another random variable, and so you could think of it as, if you want to think of it as a stochastic process, you can say, all right, well, we're going to have a discrete time stochastic process. It's not even a Poisson process because time is discrete. It's measured in years in the farming sector. And so a discrete time stochastic process, and sometimes you don't pay anything, and sometimes you have to pay something. And so what's, the chance that you have to pay is 10%. The amount of money that you have to pay is this random variable specific distribution, we call it capital F. Could be exponential, for example, distribution. In fact, it's a very common model that people use. And then you say, all right, well, I will look at the expected value. Think of that. I will look at the expected value for next year of how much money the insurance company will owe me. What is it? It's the probability that you're going to have to pay something out, multiplied by the expectation of the capital, of the random variable distribution capital F. You multiply those two things together because in the first approximation you assume that the chance of something happening, of the risk actually paying out, and the distribution of the random variable are independent. And that's not actually a bad assumption. As silly as it may sound, independence between those two events, the time at which how many years it takes, what's the chance that it's going to happen this year, the time of the next event, which is a random time, and the quantity that the insurance has to pay at that time, two random variables. One of them is just a discrete time random variable representing the time to the next event. The other one is just how much money the insurance needs to pay out. Two random variables, independent, actually not a bad approximation. It's surprising how well it works. You multiply those two numbers together, you get the average price that the insurance company will pay next year for this farmer. Then you can do some discounting. Discounting, for most purposes, they just use just your deterministic value that you think is representative of discounting rate for this particular market. They don't even try to use stochastic interest rate models. Have you guys studied stochastic interest rates at all? A little bit? Yeah, a lot. Too much? You prefer not to study stochastic interest rates? Well, in this sort of scenario, they really don't. There's no modeling at all of what happens over time for discounting. It really. Yeah.
So they do they focus just on the expectation, or do they focus on the variation around that expectation?
Well, that's right. So then the next step. So the fair price is the expectation. The next step is, all right. We have to. In the ordinary financial theory, they call this a loading factor. So the next step is, you got to figure out your loading factor so that the company who's actually providing, so the insurer can actually survive as a company. But in this case, we're talking about the federal government, and the US federal government is pouring all this money into crop insurance so that the farmers can actually afford the premium. What turns out is that when you use that it's called the actuarial principle of saying the fair price for the insurance contract is real under the objective probability measures, the real expected value, not some imaginary risk-neutral world, which doesn't exist here. We don't use it because there's no hedging, there's no risk-neutral. So under the real probability, the real expected value, that's your fair price. You're going to add a little bit on top of that. They call that a loading factor, so that the company can stay in business. But the federal government is just using money from all the taxpayers, and so the loading factor is actually a negative number. That's the incentive that the US government gives. So it's unlike anything else that you've ever seen in the financial world. The US federal government is so far behind farmers because they've understood for a long time how important the farming sector is. It's by far the most subsidized sector of the US economy, by far. These loading factors are enormous. And so in a typical situation, you're going to get that the fair price for these insurance contracts is what it is, but the farmers will only pay 90% of the fair price. That's an enormous loading factor in the negative direction. I actually looked at the numbers in actually some West African countries, and those are similar to numbers in Europe, where crop insurance is not as heavily subsidized, or not subsidized at all. And the loading factor is positive, as one would expect. It's on the order of 5 to 10%. In the US, it's a negative number in a lot of cases because the US government knows that the farmers cannot afford the fair price. Farmers would not be able to afford to operate the way that they do with the pressures that they have from the consumers and from other pressures that go along with consumerism in the United States for being able to buy cheap food at the supermarket. So that's what we're faced with. I believe that's what the issue is here. We have extremely highly subsidized crop insurance in the United States because it's not possible for the US public to imagine having to pay twice as much money as they do now for things like milk and beef.
And maybe that's a reasonable place for governments to put their cash.
Absolutely. It's reasonable, absolutely.
public good.
I'm all for public spending, just to say. So,
Are those rules applied to the, just thinking of the other big federal insurance, which is flood insurance, does this same philosophy apply to the flood insurance, do you think?
that's a great question. I think that the same philosophy applies to any flood insurance which is not unreasonable. Then when you're living in places like South Florida,
Well, I mean, there's some places where the government's just said they're not gonna offer flood insurance.
so you can look at the map of where the government refuses to sell flood insurance, and then you can look at those marginal regions, maybe the area around, the Virginia coast, where
Houston.
Houston might be another area, yeah? And so then you'll see that, so I haven't, of course, done this analysis, I've not looked at flood insurance, but I will because it's one of my plans on a different project. So I believe that when you look at the map of how subsidized the flood insurance is per area, you'll find it's actually a continuum where in some places the US government doesn't want to get involved in flood insurance, it's ridiculously expensive and they don't want to subsidize it because people shouldn't be building there in the first place. And then as you go further away from those areas, you're going to get places where it's subsidized to some level, and then you're going to get areas where people are just very risk averse and they'll be paying the fair price, and then you'll get other areas where they're actually going to be paying a significant premium because they're even more risk averse, but there's a chance of. So I think it's a gradation geographically. So having said all this, let's talk about, so we have I think 25 minutes left in the class today. So let's talk about the research that I'm trying to work on with some colleagues across the country on what we can do in order to change the way that incentives are provided to farmers to keep the US agricultural and agro-financial system stable. So the key idea is we want farmers to be able to operate and not go out of business right away. It's bad enough, as we were mentioning before, that the number of small farms who are able to operate sustainably, financially sustainably has gone down so much, it's just impossible for small farms to exist. That's bad enough, so I don't know if we'll be able to backtrack, we'll see, but at least let's try to keep that, let's keep it, we're hemorrhaging small farms in the United States at a very rapid rate. Nothing worse than the dairy industry, but the corn and soy is almost as bad. Let's see if we can at least stay at the level where we are and keep all the farmers who are currently operating in business. And at what expense do we do that? So right now the expense is that we have extremely heavily subsidized crop insurance, as I've explained, using very simple principles, which I didn't write on the board because it's so simple. And I don't have any problem at all with using simple mathematical principles in order to price objects. We're talking about markets which are highly illiquid, and even worse, they're very far from being hedgeable. They're very far from being complete, where you can find a hedging strategy for any risk that you want to try to buy and sell from people. So because of that illiquidity, and because if you want to buy a farm, believe me, it's an illiquid market. And because of the fact that we can't find good enough hedging strategies to guard against the kinds of risks that farmers are facing using other instruments, we have these incentives in place which allow farmers to operate. I'm just repeating. And we have, as I mentioned at the beginning, we have these incentives are designed in a very simple-minded way. Not that there's anything wrong with that, because it's been working. It's been working fine. We've been able to support at least the richer farmers. At least we haven't had a financial, agro-financial system collapse. It hasn't happened. It's been going on for a long time. The Green Revolution, which is how we got to the level of productivity that we have today, started maybe 67 years ago. It's still going on. We've been doing very well, but we're now coming to the realization that there's a problem, as I mentioned in my abstract. The incentives that people have, because as I mentioned in my abstract, the US government has decided that not only is it great for the US to produce a lot of corn, since we can grow cows and pigs and chickens. We can grow cows and pigs and chickens very, very efficiently by growing corn right here in the US. We don't need to buy really corn from anybody. We also produce soy, because it turns out that for the soils where the corn is produced, if you do a 2-crop rotation, you guys have heard of the term rotation? Like you grow one crop one year and then you grow something else the next year. The simplest rotation that you can do is a 2-crop rotation where you grow corn one year and soy the next year, and you apply fertilizer so that it grows well and you get a good yield, and you can sell, you get enough corn produced in the country so that the consumers are satisfied, and not too much, because then the prices would go down and then you could go out of business, or the government has to step in and pay too much money, and then they might change, the next farm bill might change the law. And So it's all very, it's a very delicate dance, but it's all based, so we have corn soy rotations, works really well in the Midwest, been working for a long time. But people are realizing this is not sustainable from the standpoint of the ecology of the soils. I mean, at some point, so another side note is that, has anybody ever heard of a weed killer that's called Roundup? Raise your hand if you've heard of Roundup. Okay. All right, so Roundup has some pretty nasty externalities. The so-called, and I don't know if you guys had ever heard of the Green Revolution, but raise your hand if you had. Yeah. The Green Revolution started many decades ago. It's still going on today. I actually have a paper where we analyze the productivity gains, and we proved in this paper, this was published 3-4 years ago, that the money which is spent on research in land-grant schools in the U.S., like Texas A&M, is highly correlated with the productivity gains that we've been having since the 1950s, or even before 1930s, go back. So the Green Revolution is great, it's been working. It's just that now we're coming to the realization that with all the productivity gains that we've had, growing corn and now soy in the US, where the US government has decided they want to subsidize corn because US is the biggest corn producer in the world and they want that to continue because it helps us on the world markets and it helps our economy. Those incentives are there so that the US stays the dominant corn producer in the world. And so we don't have to worry about what we feed our pigs and cows and chickens. We know we can produce the corn. We know that the farmers are getting half-decent prices. When the prices are too low, the government steps in and props them up so no major farmer goes out of business. It's working. The problem is, we realize now, and actually it's been 20 years, that the more we produce corn and soy at these high levels of yield, by using things like Roundup, where we kill all the weeds and you never need to till your field because there'll never be any weeds. We have genetically modified versions of corn and soy where you can spray everything in your field with this weed killer and everything dies except for your crop. You guys heard about that? That's Roundup. You should call it Roundup Ready crops. You drive around the Midwest, and maybe even here in parts of Texas, like further west, north and west, in the Panhandle, maybe they're growing corn now. They are growing corn in the Panhandle. You drive around and you see, before the corn comes up in the spring, there's not a single weed in any field. Anybody here live in a house where there's a yard? Yeah. How are you guys dealing with your weeds? Anybody have any clover? How about dandelions? Anybody ever see the dandelion? How fast they grow? And how many seeds they put out? None of these things exist in farmers' fields because we have Roundup Ready crops where you can spray the field with the Roundup. Everything dies except for the corn and the soy. So we're now realizing that there's negative externalities of the Roundup because it's affecting pollinators, and if we don't have pollinators, that's also another reason why we'll have no food. So it's a little bit problematic that Roundup may be a cause of decline on pollinators like honeybees, and native pollinators like there's a lot of bumblebees in the United States. So there's a ton of different kinds of pollinators, and they're all affected by Roundup. So that's a problem. Even worse than that, the soil. People realized maybe 10, 15 years ago that in a lot of these cases, the soil where the corn and the soy is being grown is actually dead, and the only reason that these plants are growing in the first place is because we're applying so much fertilizer and so many different chemicals that the plants can grow even if there's no nutrition in the soil. Now that's crazy. In other words, there are many farms, and of course now we're beginning to realize, and so farmers are just like, this can't go on, and so the farmers themselves are taking measures to avoid this type of agriculture, but not everybody. But we're talking about an agriculture system where until recently, the topsoil was actually just a matrix with no nutrition in it. You can go in and you can look for worms and you won't find any. You can look for other types, you can look for insects or songbirds and you'll find nothing. There's nothing. It's just a matrix. It has no nutritional value, and the corn and the soy are growing because of all the fertilizer that we're applying. Not a sustainable system. We can't be working in a world where farming, as you were saying before, Professor, it's just like a greenhouse. I mean, it's not a building, it's just out in the open, but there's nothing in the soil. So that's where the research groups, the two different research groups that I'm working with are working on. Of course everybody agrees, and the farmers will be the first people to say so. We have to bring soil health back to American farms. And if you go to other countries, they haven't tried to achieve the kinds of yields that we have in the US, and so they have better soil quality because the yields have been lower. You go to Africa, for instance, and you'll see that people talk about organic farming in the United States where soils are very healthy and we don't use chemical fertilizers and all those sorts of things. And Well, in Africa, nobody's growing anything organic because everything is organic. There's no problem with soil health other than, maybe it's people are trying to grow too many things all at once, and so that depletes the soil a bit, and then you need to add manure to bring back the health of your soil. And I've had a couple of papers I've written with colleagues on that topic. But in the United States, we're talking about a system which is highly unsustainable since we actually got to the point where the soils were completely dead, and you couldn't grow anything of any sort without applying chemical fertilizers. Which is, sadly, it's good for Houston because those things are based on hydrocarbons. So that's also very sad. So it's really unsustainable from a climate perspective because we're using hydrocarbons, unsustainable from an ecological perspective because the soils are dying or already dead. You can bring back soils pretty quickly if you apply proper, I don't want to use the word proper, but if you apply soil-friendly practices as a farmer, you can bring your soil back to health. It's incredible how fast you can bring a dead soil back to health by applying certain types of farming practices. This is what we're studying with these two research groups. Let me just describe quickly what we think we're discovering. We haven't published any papers yet, but we're writing two different sets of papers. One of these groups is working with remote sense data. You guys all know what remote sensing is? You take a satellite, you take pictures of the surface of the Earth. From those pictures, you talk to folks who know how to analyze the data from pictures, pixel by pixel, and they can tell you, this is what's growing here, this is what's not growing there, this is how much water there is in the soil over here, just by looking, just by the satellite picture. So we use remote sense data. We also have remote sensed hydrological data. We can even figure out how much rain has fallen in an area over time because the frequency of taking these pictures by satellite, it's such high frequency. It's incredible what you can, so I don't know any of that, but I just use the data they give me. The data has some small, you have to ground truth the data, so you have to go to measure on the terrain to see how close you are, and it's getting really good. So we're just using remote sense data with this one group over more than 1 million farmers' fields in the Midwest. That is an enormous number of fields. We have the entire Midwest, basically. We have 9 states, most of the Midwest covered with our data set. And we are in the process, we already have some results. The results that we have in the state of Illinois. Illinois is a state here in the US. You've heard of the city of Chicago? Well, if you've ever been to Chicago? Big city, yeah, bigger than Houston. You drive out of Chicago? Drive out of Chicago.
That's debatable. I'm back and forth.
Is that right?
Chicago to Houston.
Well, the so-called Chicago land has more than 10 million people, so I think it's got Houston beat there. But as you drive out of Chicago, it doesn't take too long, except if there's a lot of traffic, for you to end up in the Midwestern farms. It's just the same. It's the same as the rest of the entire state of Illinois, except for Chicago land. It's just all corn and soy fields as far as the eye can see. And because this is interesting for perspective of statisticians. The state of Illinois, there's a gradation from south to north because in the south it's warmer, drier, in the north it's wetter and it's cooler. It's a big distance between south and north. It takes hours to drive through from south to north. But that's not a very complicated geographical gradient, if you will, because it really is from south to north. So our data analysis is able to handle that gradation. From east to west, there's hardly any variation, and the state is extremely uniform. And so in the state of Illinois, we've been able to show without any doubt that certain farming practices, which have been used recently by a subset of farmers, and we would like all farmers to try to adopt them, are beneficial for soil health. And in particular, the most important thing, our message that we're going to get across is, it's not just the soil health that's getting better, which is important because we can't handle destroying the soil anymore, but there's more. Not only is it extremely beneficial for soil health, and I'm talking about, we don't have a whole lot of time, so I'll just mention the practices. It's like reduce till or don't till your fields at all. Plant cover crops. I couldn't find my plant cover crop t-shirt. I have a t-shirt that says, don't farm naked, in big, big letters, and then you have to look closely, underneath it says plant cover crops. So for those of you who know what cover crops are, when you harvest your crops in the fall, like the corn and the soy, it used to be that people would just leave their fields completely open, and then the weather would come in the winter, there'd be snow, there'd be rain, you'd get erosion. You can avoid all of that. If you plant something else in the fall, you could plant what we call a winter wheat, which you could then harvest in the early spring. You could plant cover crops which animals can come and eat, like turnips, or you can plant just ordinary alfalfa, or actually, your cooler weather pasture that you can plant as cover crop, and then you can bring your animals to graze on them, or you can kill them with Roundup, which then enriches the soil even though you're using your hand. So cover cropping, it's a thing. It works really well. And also another thing that works really well, which is harder to implement, is increasing the number of crops in your rotation. Rather than just corn and soy, add alfalfa as a third year. Alfalfa, great. Alfalfa, very valuable crop. The cows love it. That's how they produce milk. Everybody loves alfalfa. Everybody loves alfalfa. Great cover crop to plant. You can harvest it. You can use it. You can plant alfalfa, harvest it 2 years in a row, and then go back to corn and soy for maybe 3 years or 4 years. Or it depends. You can try different things. These practices enrich the soil. They have another benefit. Let me ask you guys, what do you think is the benefit? Like, think of cover cropping and think of rotations where you have several crops. What do you think the other benefit might be compared to a simple farming system where all we do is corn, soy, corn, soy, corn? What do you think? Any guess? Just guess.
Diversification.
Diversification, what does that do? Yes, what does diversification do in finance?
Reduces risk.
Reduces risk, exactly right. It's exactly the same in the US farming system. When we diversify the types of crops that we're growing, the methods that we use, and then the methods, and then these are actually, in some sense, it's a hedging method. We're going to plant cover crops, which is going to hedge against the risk of a really bad storm coming in and taking away some of your topsoil. That's a great hedging strategy. It's an actual hedge. Like you can see your crop is going to grow this tall. It's an actual hedge. Yeah. So, sorry.
Oh, that's classic.
Yeah.
That's really good.
Yeah, actual hedge. Yeah, and then your sheep will go into the field in winter to forage on your hedged crop, and it's so tall that you won't see the sheep anymore, and they'll be very happy. Yeah. So that's for people who have sheep. So if you bring cows, the same thing happens, but you can still see the cow. So that's when you realize it's really a hedge. Yeah. Some of this could be considered a hedging strategy. Some of it is just pure, good, old-fashioned diversification. Everybody knows that when you diversify a portfolio, you may eat a little bit at the top level of the very highest return you might possibly get in a good year, but you're also going to eat away at the low risk, and that's what we're showing. We're looking at, so here's an interesting thing. We were speaking with our farm lending partner, whose name is CoFES. What's the name of the farm lending cooperative? And we were like, we're going to try to figure out for you guys what the risk is of falling below that 8% level or that 90% level for people who want to buy the more expensive 90% level crop insurance. And they're like, yeah, but there's crop insurance for that. And we're like, yeah, but what we're trying to do is influence the federal government. So this group that we're working with, Land Corp, they're like lobbyists. So it's an advocacy group, nonprofit. Not really a lobbyist, they're nonprofits and they're trying to influence the government in order to pass laws which will be better for soil health. And we're like, we need to influence the government so that they stop selling these products and they give other incentives to farmers where they can reduce their financial risk at the same level while being much more beneficial for soil health so that the farming system at an ecological level remains sound and actually becomes less risky. We want to do that. We want to try to figure out, this is what our thing is. We want to try to figure out what the financial incentives could be based on the risk reduction that we can provide to farmers using these practices, find out exactly how much money they're going to be, how much risk reduction in terms of dollars we will be seeing for them, and then either the federal government through crop insurance restructuring, or the lenders themselves through their private lending that they do, because it's all private. How much can a lender give as an incentive, give as a bonus to the farmer because the risk has been reduced? Lending is all about risk too. They want to figure out which category of risk these farmers land into. If we reduce the risk on the low side substantially because the farmers are using better practices, then the risk of default, or even going bankrupt on the loan is reduced. So the farmer jumps into a less risky category. That gives them a better percentage for their risk. It's like an incentive. It's actually a bonus. You have to pay less in interest rate. Interest is a major cost of farming operation. Margins are very small, so every time you get a better interest rate, it's great. That's what we want to do. And we're like, yeah, we want to do that for the farmers. We're talking to CoFES, our lending partner. We want to do that. We want to work on the crop insurance. Yeah, but come on, buddy. Crop insurance is the federal government. Good luck to you. So we didn't argue with CoFES because they're a lender and they're just peddling crop insurance as lenders do in the US. The federal government does it. They don't see their business going away. They don't believe it's going to go away. So that's a separate conversation we can't have with them. We're having a conversation just about lending. But then we thought, but you know what, listen, okay, we're going to work with these people. these lenders, and they don't want to hear about our estimation of 80% risk and 90% risk. Fine. What number would you like to hear? They're like, well, come on, we want to hear your 95% risk. What is your 95? What is the risk of falling below 95% of your usual 10-year, average revenue for your farm? If you can tell us that, there's a crop insurance that exists for 95% risk, but it's so expensive that only the richest farmers buy it. It's a much higher risk of falling below 95 than falling below 80, right? So it's much more expensive because the frequency of that happening is much higher. Almost no farmer buys it. Only the richest farmers buy it because they can afford it. And only because they're very risk averse. They want to take no risk at all. So it's very relevant to our conversation with the farm lender what the 95% downside level is. And we've computed this downside level using our data for the entire state of Illinois. We're working on other states. We're still gathering some of the data. In Illinois, there's no data at all. It's incredible. What we've shown, thanks to the data analysis that we did, and we used just ordinary Bayesian statistics to do this. It's just nothing fancy. It's just very hard to set up because the data is so complicated and vast, but the tools themselves are very simple. We showed, using Bayesian stat, which is very easy to implement when you're trying to compute probabilities of things happening, it's perfect. Any Bayesians in the room here? Bayes? That's great. Like I say, I'm an atheist, but my religion is Bayes, for sure. So we computed these 95% downside risks. We also computed, this is something else that the farm lender told us to try to do, the 105 upside potential, because there's that too. In finance, we do this all the time. When we compute volatility, we were mentioning volatility earlier, volatility is on both sides. We don't generally think the volatility is only downside, right? In farming, it really makes a difference whether it's down or up because you have different products or different strategies. So the downside risk gets reduced every single, I think there were 95 counties in Illinois where we had enough data to run an analysis. In every single county in Illinois, the proportion of farms where the downside risk was reduced substantially was extremely high, like it was in the 70 and 80, astounding. So using these better farming practices, which are better for soils, also reduces your downside risk, as one would expect, because it's a diversification effect. We can just talk about diversification. We can talk like we're doing right now, and we can convince people just by talking, or we can convince people by actually running the numbers. And we ran the numbers for Illinois, and it's 100% sure. Everybody in those parts of Illinois should be trying to do these farming practices if they want to reduce their risk. And then, so I'll probably won't have time to talk about the second project, which is similar in philosophy, so I don't need to, but for this first project, the next question was, well, wait a minute. So if you speak with farmers, so by the way, I spend a lot of time speaking with farmers. You don't have to ask me why, but it's the way it is. I know a lot of farmers. So when you speak with farmers, the first thing that they will actually look at you, and they don't even just need to say anything because you know that they understand that you don't understand. Now I do understand, so it's okay. But you will tell them, yeah, you know what? We figured out that if you implement these practices, your downside risk when you're producing corn is going to go down a lot. It's going to reduce your risk because diversification, in theory, it should work. In practice, we know it works. It's going to reduce your downside risk substantially. So why wouldn't you do it? Because it also makes your soils healthier, and then we can preserve the ecology of our soils for posterity. Yeah, sure, yeah. But how much is it going to affect my yield? How much is it going to affect my yield? And so that becomes a very difficult conversation to have because you're reducing downside risk, but you might also be reducing the upside potential. And that's the margin. That's how the farmers make their money. So it's a really difficult thing to address with farmers because you also have to show them that the hit that they're going to take on the upside is small enough that it doesn't actually affect their bottom line significantly. Now, one of the things that happens with reducing the yield at a systemic scale is that it's going to reduce the production. So if you reduce the yield slightly at the scale of the entire country, it's going to reduce production, and that's going to raise prices. So the U.S. farming system only can handle so much of reduced yield because there's demand, of course. And again, I'm not an economist. But if there's a slight reduction in yield, it doesn't actually necessarily represent a reduction in revenue. In fact, sometimes it represents a lift in revenue because the prices follow. There's a very strong correlation between reduced yield and higher prices. So if the reduced yield is kind of on the marginal side, you run the numbers with what you think the prices will be doing, and this is something we haven't done yet, so we need to do it. I'm working with an economist from the University of Arkansas on that. We're going to show that the farm revenue with these soil healthy strategies doesn't actually take any major hit at all. But in Illinois, what we've already showed is that if you don't look at the yield from your clover or your alfalfa or these other cover crops that you're using, or the other parts of your rotation, if you just look at the corn and soy, actually these soil healthy strategies also in most cases increase the yield on the upside. So remember, we talked about, this is very, very simple math. Like, what is the 95% downside probability? What is the 105% upside probability? The downside probability goes down when we implement these soil healthy practices. It turns out in Illinois, the upside probabilities go up under the same strategy. So there's actually no downside to yield. There's no downside to yield, and there probably isn't a real downside to revenue because price fluctuation is such that it comes out in the wash. Like the volatility is such that small of an up or downside isn't really going to affect anything. So we can talk to the farmer, and you believe me, the farmers are smart. They understand finance at the level that they need to understand on their farm operations. And so these are things that we can explain to farmers. So I'm really looking forward to actually having conversations with farmers. This group, LandCorp, is putting together a group of farmers that they can use as consultants, so we can actually have direct one-on-one conversations in a formal setting, which I highly recommend. When we have stakeholders, Professor Inser, I'm sure you know this, you've done this a million times. When we have stakeholders, there's no substitute when we're running data analyses to actually being able to present those analyses to the stakeholders and have them give us feedback. We're going to do that. It's part of our plan. In fact, the grant that we have has that in the proposal, so we have to do it. And we're going to find out from the stakeholder farmer group and from the lenders that, yeah, I mean, they'll be satisfied that the yield on the corn side does not get so low that it puts their farm at risk. The slight little problem, so here I'm going to admit that this is something which we haven't really ironed out yet. Nobody seems to think it's a big deal. I think it's going to be a problem, so we'll see. Stay tuned, maybe next year I'll tell you more. Slight little angle is that when you're doing this longer rotation, so there's these three types of practices that you can use in order to improve the soils on your farm. You can reduce tillage, which is how you turn the soil over. Don't turn the soil over at all. It'll reduce erosion. It's much better for the soil. The worms are much happier when you don't till. You know how hard it is on the worm to get cut in half when you till through? It's very hard on the worm. Yeah. So reduce tillage or no till at all. Plant cover crops. It's the easiest thing. You know how easy it is to plant cover crops? In the upper Midwest, there's snow on the ground part of the winter. You can go in and you can throw seeds all around, or you can use a little machine to do it. And this is called frost seeding. Anybody ever heard of frost seeding? It's at the end of winter when there's still snow on the ground, but the days become warm and the snow melts and then the ground freezes again at night. You can broadcast any seed you want, and it's the best way to plant most of these cover crop seeds. So it's the easiest thing to do. You can save yourself all diesel because of not having to run your enormous seed drill through your untilled field. It's like such a good deal. So planting cover crops is not a big deal. Easy to do, not expensive, saves farmers money. They don't have to run their equipment. Time is a huge issue with people who have large farms, 2,000, 3,000 acres. They can't plant stuff like 5-6 times a year. And they can't. It's not going to happen. So being able to use a very light piece of equipment where you zoom through your field and you broadcast over 30 feet, it's much better. So that's great. And then the hard one is rotational complexity. That's a little harder to implement because it takes years. But you implement these different practices. The one angle which I'm worried about, and I'll stop there, is in these rotational, that's the biggest thing you can do for soil health. It's better than, we think, from our data analysis. We think increasing rotational complexity, more crops in rotation, is even better than cover cropping, and it's even better than reducing soil erosion by not tilling at all and keeping the soil. It's the best thing you can do is increasing your cropping rotation complexity. But the problem is that if you take a 6-year rotation where there's 3 years of corn, and then 3 years of alfalfa, the revenue that you get for alfalfa is never going to be as good as what you get from your corn or even your soy. And that's a problem. That's like the elephant in the room. And I try not to talk to farmers about it because I know that they're going to be like, forget it.
It's also the equipment and everything.
Yeah, it's the equipment.
Right.
So So we'll see how that pans out. The upside, the better upside under these soil healthy practices is real, but it doesn't take into account that you can have reduced revenue from these lower yielding crops like alfalfa or turnips or whatnot. So thank you very much for your patience and attention today. I appreciate it.